Good morning, everybody. It's 9:59, so we're just a minute early, but it's time to get started on our Tuesday weekly webinar. I'm really looking forward to this discussion today. We are going to go over our basic information that we usually do. We usually go over our Slott mailbag reports. There is actually a lot of stuff over the past week that came in from the Slott mailbag and Slott report, and I had to winnow it down to just two. Otherwise, we'd spend our entire time talking about Slott updates, but that's sometimes there's one or two and sometimes there's many. They get requests just all the time from people with questions. Next, actually, it's almost September, so it's August 30th right now today, obviously, but it's almost September. But in October, I'm going to be live in Las Vegas with Ed and his team for our semi-annual updates. I'm really looking forward to that. Vegas isn't my favorite place to visit, but we're trying to make an extra trip out of it. We're seeing some sites out there, the Grand Canyon and the Hoover Dam and all that fun stuff. So, but I'll come back to you at the end of August with, I'm sure, a lot of information from the Slott group, like I always do. We had a great, I think, a great special webinar last week with Alicia Barnett from the Financial Independence Group. And somebody asked me, a new client asked me last week, who is this FIG that I was referring to? And the Financial Independence Group is a partner of ours who helps us weed through all of the insurance offerings out there. So whether it's life insurance, long-term care offerings, annuities, they help us weed through the details. There's just so many different companies with all these offerings. So for example, we'll say to them, we have this client with this issue, what's the best fit? And they'll give us, 3 to 4 different providers out there. So it's really a funnel, helps our team tremendously. So they're an independent group. I like the fact that they're independent. They're not tied to any one company. That's been a feeling of mine from the very beginning. Even when I worked at the big firms, Payne Weber, UBS, Wells Fargo, Wachovia, it was important that I, with the exception of UBS, I used one UBS fund back in the day when I was there, but I never liked the idea of, certainly not having to use investments that were tied to the company. And that's honestly one of the many reasons I left Wells Fargo. But they were very siloed. They wanted you to just use Wells Fargo everything. But it's important that we get true independent information and resources without it being tied to what the stock price is at the end of the day for a large company. So I'm going to stay off of my soapbox on that. But now that we're past the 10 o'clock hour and we'll probably have all the folks who are going to join us, I want to say welcome. If you're watching this on YouTube, I have to apparently say, click the like button, please subscribe and click the notifications so you get the notifications on there. As always with these webinars, we do go over the Slott updates that we get from Ed Slott, as I was talking about. We spend about 15 minutes on that. We spend about 15 minutes on market updates, so probably a little bit more to talk about today. And then there's a 15-minute financial planning topic. Today's topic is going to be the beginning of a series. So I'm actually very excited about this. So the series is going to be investment fundamentals. So this is, I think, a really great time to talk about fundamentals. Market was down over 1,000 points on Friday. It was down yesterday. It's down slightly today. My feelings about where the market's heading. I think it's going to be a really tough go of it over the next year and a half, 3 years, maybe even 5 years. Now, we're going to talk a little bit about what the Fed said on last Friday, and there's a lot of concerns. The new college debt forgiveness bill has a lot of people concerned. Not bill, just executive order. Sorry. Has a lot of people concerned. That's moving the markets as well. So, as long as we're dealing with higher inflation, higher interest rates, political maneuvers like this, we're going to have volatility in the markets. So now is a really, really great time to talk about investment fundamentals. How do we structure investments? Why do we choose what we choose? How do we set these things up? And what does it really look like? So we're going to go over the next 4 or 5 weeks. We're going to talk about asset allocation, which is today. Asset allocation, what does that really mean and how is that put together? Passive investing versus active management. So exchange traded funds versus hiring a money manager via mutual fund or independent separately managed account, or sometimes referred to as TAMPS, turnkey asset management program. So what the pros and cons are of each of those. We're going to talk about individual security stocks and bonds. We're going to talk about rebalancing, what that really means, how that all works. So we've got a risk analysis. I've got a series of 4 or 5 weeks laid out that we're going to where we're going to really dig into these topics, spend a little bit more time than we typically can when I'm trying to cover them all at once. So I hope you enjoy that, and I'm looking forward to that. So we had Alicia last week. We talked about long-term care, the issues with long-term care. Alicia had some great information about really kind of the pain that the long-term care problem causes for individuals. Over 70% chance if you're over 65 that you're going to need long-term care during retirement. The outrageous cost of those long-term care issues, depending on what your need is and where you live and how to fund that. And she talked about asset-based funding, which is a really innovative approach that's really come about over the last decade or so with some changes in legislation. So Alicia's part of the Financial Independence Group, and she's one of them who says, okay, well, here's this issue you have. Here's a potential solve for that issue. So great resource to have. I think she did a fantastic job. She's a really, really intelligent and nice woman, and very helpful to our team. So I hope you enjoyed that. If you attended that, I will be sending out that video, I'm hopeful, tomorrow as a recording. We had some editing that we had to do just on our end, really me. So that's done. Should be done now, and we'll send it out tomorrow. My hope. As I said, today we're going to talk about investment fundamentals, asset allocation. And just want to remind you that you are muted. There's a Q&A section on the bottom of your toolbar, your Zoom toolbar that you see. Chat is disabled. And of course, as always, this webinar is being recorded. So let me just check in. Just click raise your hand button if you can see me and hear me okay. Wonderful. That's helpful because I'm going to be sharing my screen. And that was one of the things when we were doing the webinar, I accidentally shared the wrong screen. Thankfully, I had closed down all client information, as I typically do before a webinar, because of, sometimes that happens. As I've been using Zoom now for over 2 years, and sometimes I still make mistakes. So I'm just going to pull up my notes again. And for you new folks that are joining us, if me looking around, I'm not looking at the TV screen or checking my text message. I have 3 screens that I access. So sometimes I'm reading notes or just pulling information down for you. All right, so let's get into it. So let's talk about the headlines a little bit, because there were some big ones this past week. So on Friday, our Fed chairman, Jerome Powell, did his speech in Jackson Hole, Wyoming, which is Warren Buffett's big event. He pledged that the central bank will use our tools forcefully. That's the quote. Use our tools forcefully to attack inflation that is still running near its highest levels in more than 40 years. Let's see. Powell added that higher interest rates will likely persist for some time. Quotes, the historical record cautions strongly against prematurely loosening policy. So what he's saying is we're not looking to raise rates and then back down, or raise rates and back down. He's going to keep his foot on the gas as far as raising rates. The remarks come amid signs that inflation may have peaked, but is not showing any market signs of decline. Powell said the Fed will not be swayed by a month or 2 of data. So he seems to be all in, very what they call hawkish, really looking to continue to raise interest rates. There's a lot of concern about that, of course, from a economic point of view. If interest rates get raised too consistently for too long, it can really slow the economy. On the other hand, if we don't raise interest rates, then we have this wild inflation that we're experiencing right now that just potentially continues. So I would not want to be certainly not the Fed chair, but or a manager of the Federal Reserve, right, or a participant in the Federal Reserve right now board. Some interesting news about some legislation that's proposed out of Washington about Social Security. So Representative Angie Craig out of Minnesota, she's a Democrat, has introduced I only say that because that's what it says here in the article, that she's Minnesota, has introduced the You Earned It, You Keep It Act legislation to repeal federal taxes on Social Security benefits. So remember, you folks are all expert at this now, but you know that your Social Security can be subject to tax. So it's based on provisional income. Provisional income is a separate tax calculation that determines how much of your Social Security is subject to tax. So the IRS uses that provisional income calculation to track how much of your Social Security, or track the income that determines how much of your Social Security is going to be taxed. It can go from 0 to 85% of your Social Security. And the thresholds are getting smaller every year. So it's only for a married couple, it's $0 to $32,000 not to have any tax on your Social Security, from $32,000 to $44,000, up to 50% of your Social Security is subject to tax, and over $44,000 of provisional income, and that has its own calculation. It's not adjusted gross income. It's not taxable income. It's not modified adjusted gross income. It's provisional income. That is up to anything over $44,000 for a married couple is up to 85% of your Social Security is subject to tax. Not taxed at 85%, subject to tax. Single filers are, of course, worse. It's 0 to 25,000 in provisional income to have none of your Social Security taxed. 25,000 to 32,000, up to 50%, and anything over $32,000 up to 85%. So those provisional income brackets are pretty easy to hit, and they get easier every year because they are not adjusted for inflation. What Representative Craig is saying is, let's just eliminate that. Let's eliminate Social Security taxation altogether, and instead what we'll do is we'll extend the payroll tax on wages up to $250,000 from where it is now at $147,000. So what does that mean? Well, if you make over $147,000, then none of those earnings above $147,000 are subject to Social Security tax. She says, take it up to $250,000, and we can then eliminate taxation of Social Security. Seems reasonable to me. I'm not opposed to that. Just me sitting here, have no say in Washington other than who I vote for in Congress and the Senate, but seems reasonable to me. Craig said the tax cuts would have no effect on monthly benefits that enrollees receive each month and would be fully paid for by raising the caps, as I said, for individuals earning more than $250,000 annually, and asking them to continue paying into Social Security each year. There's a fellow named, same article. This comes from one of our trade magazines that's, online. I think it's called Think Advisor. But Dan Adcock is the Director of Government Relations and Policy at the National Committee to Preserve Social Security and Medicare. He said he preferred the legislative vehicle for accomplishing these goals in the House Bill 5723, which is the Social Security 2100, a sacred trust. So that was introduced by the House Ways and Means Social Security Subcommittee Chairman, John Larson, also a Democrat out of Connecticut. He said that would reduce the taxation of Social Security benefits by increasing the income thresholds below which benefits are not, which determines what the benefits are taxed. That's not what he said there, but I'm filling that in. So what they're suggesting is increasing the provisional income thresholds. Well, that would be nice too. Adjust these things for inflation, and less people will be affected. The good news about this is that I don't think either one of these really has a chance, frankly. But the good news is that people are talking about it. I'm all for letting folks who are collecting Social Security have that be a tax-free vehicle. One of the things that we like to do is set up tax-free lifetime streams of income for people. Social Security can certainly be one of them. And we often do that, get people to tax-free Social Security using our methods, but this would be a great help. Any kind of help like that coming out of Washington would be wonderful. And they also say the Sacred Trust bill is also applied. I'll read this to you. Sacred Trust are paid for by applying Social Security payroll tax to earnings income above $400,000 a year. So that $400,000 a year is the real target. So there must have been some kind of study that said here's what people will accept. They'll accept taxing everything you can of people over $400,000 a year and not below that, because that's their focus. Really, really interesting. All right. So that's basically the headlines that I wanted to talk about this week. Where there's still a lot of conversation about, are we in a recession or not in a recession, folks? We've had declines over the last 2 quarters. Even the employment sector is declining as far as number of jobs. So it's we're here. Welcome to a recession, in my opinion. So that's just my humble opinion. I really think that the economists are going to look back on it in several years and say, well, really, we were in a recession from March 2020 until whenever this is going to end, if they're all being honest. And we hope that they are. So here's our Slott report. So I'm going to share my screen. I've learned that this makes it easier for you. So here I go. I'm going to share my screen. Oh, before I forget, there will not be a webinar next week. So next week is a holiday week. Obviously, Labor Day on Monday. So hopefully everybody gets a day off. I find it difficult to gather the information that I need for an effective Tuesday morning webinar when there's a holiday the day before. So I just made a policy that no webinars after a market holiday. So feel free to dig into the videos that you can find online. So this was a really interesting one. I thought this is from our friend Ian Berger. Caught in a trap, RMDs from 401k plans in the year of retirement. So this is a little long, just stay with me. I'm going to read through it with you. So here's a common question they get. He says, an employee retires in or after the year he turns 72, the new required minimum distribution age as of a year and a half ago, maybe 2 years ago, is age 72. And he wants to roll his 401k funds to an IRA. The question is, does an RMD have to be taken before the funds are rolled over? So he's 72 years old. It's a 401k. It's a company retirement plan. Are there still required minimum distributions? Well, not if you're not working, or there are if you're not working, but there aren't if you're still working and you don't own more than 5% of the company. What makes this tricky is the required minimum distributions, RMDs, normally don't need to start until April 1st, following the age 72 year. So April 1st of the year following the year you turn 72. So if you turn 72 in December of this year, 2022, you actually don't have to take your first distribution until April 1st of 2023. Most people take it in that first year, and you probably should, but there are exceptions. Or April 1st following the year of retirement for somebody using the still working exception. That April 1st is considered the employee's required beginning date, or RBD for your RMD. If the 401k to IRA rollover takes place before the required beginning date, it would make sense that no RMD should be required before the rollover occurs. But as is the case with many IRA and workplace plan rules, remember, folks, IRA rules and retirement plan rules are different. There are some similarities, but you have to look at the rules differently. You can't assume because you can do something or not do something in an IRA that it's the same for a retirement plan, vice versa. What makes sense isn't always the correct answer. The correct answer is that an RMD from a 401k must be taken first, and only what's left can be rolled over. Well, how can that be, he says? Well, first, the IRS says that the first funds distributed in a year in which an RMD is required are considered part of the RMD. That's the first dollars out rule. Second, the first year in which an RMD is required is not the year of the RBD. It's the year of retirement. That is the year before the year of required beginning date. Third, and I know that's confusing, right? So that again, this is why you should try not to do these things yourself, because this is where people get jammed up, or even, it's bad enough that people get caught up in these things doing themselves. But if you're dealing with a company, an advisor that isn't really keyed into these things, big mistakes can happen. And unfortunately, you can't undo them typically. Third, RMDs can never be rolled over. Putting all three rules together means that the first dollars received in the year of retirement on or after age 72 are part of the RMD and aren't eligible for rollover. What happens if they get rolled over? Well, if an RMD is rolled over, it is considered an excess contribution. To avoid penalty, excess contributions, along with any earnings or losses attributed to the excess amount, must be returned by October 15th of the year following the year contribution was made. So he goes into an example. I'm not going to belabor it, but I'm just going to leave it like this. You've got to be really careful when you're doing these rollovers, even from a retirement plan. Sometimes it's easy. There are companies that handle it really well. I mean, like the Fidelities of the world, the Vanguards of the world, and other plan providers. But but even those folks, you're calling up, and the person on the line has been doing it either, this is their 5th day or their 5th year, so you really don't know. So it's good to have that help. Here's a Roth conversion. Oops. So this is from Andy Ives. You've all met Andy. An advisor called to discuss Roth IRA conversions, something we do all the time. His new client made some decisions before speaking with him. And he was trying to untangle her self-inflicted knot. She was 69 years old, a single tax filer, still employed, and had $1 million traditional IRA. Based on advice from her brother, who is not a financial professional, she had already ripped through Roth conversions of $200,000 for both 2021 and 2022. The brother's only consideration in making his recommendation, it was the market is down. So this is that brother, cousin, uncle, plumber, friend, neighbor issue. Not, disrespecting any of this, but, I've had people come to me and say, well, my realtor said this, or my plumber was over and he said, or she said, I should be doing this. Folks, pick who you're getting your financial advice from. So again, you should have your team together. You should have a certified financial planner. You should have, in my opinion, a CPA. You should have the attorney that you need, a qualified attorney. And you should be getting your advice from that team. At least one qualified attorney. You might have business interests and you need several, who knows? But you should be getting your advice from that team. Of course, it's advice, right? You're going to do what you're going to do, but try not to take advice from non-professionals or people who aren't studied in this. Listen, I wouldn't hire an attorney to handle a landlord-tenant complaint who develops business contracts. There's specializations. We specialize in this kind of stuff, this effective drawdowns of IRAs, tax efficient transfers of IRAs, things like that. You've heard me say it a million times. There's only 400 of us in the entire country who really spend the time, resources, and the education that's required to stay on top of these things, because it changes all the time and they're confusing issues as you see. So please don't listen to those non-professionals or those professionals who aren't up to snuff. So here are the consequences. First and foremost, Roth conversions cannot be undone. We lost that. You used to be able to do a recharacterization until the Secure Act. And they eliminated recharacterizations. So Roth conversions cannot be undone. There is no recharacterizing a Roth conversion. Roth contributions can still be recharacterized, but that's a different topic. So these $200,000 conversion knots cannot be untied. Regardless, we still needed to explain the ramifications of the transactions and how to approach things differently in the years to come. Well, of course, taxes. Roth conversion is a great strategy, but you have to pay the tax when you move it from a traditional IRA to a Roth IRA, unless there's some after-tax contributions in those IRAs. And he says that, so you got to determine the amount of tax and where it's going to take you in your marginal tax bracket, what that dollar amount of tax is. In each and every year, assuming this person had no after-tax dollars in her traditional IRA, then the entire conversation would be conversion would be taxable. This year, she added $200,000 of ordinary income to her roughly $50,000 of earnings. For a single filer who took the standard deduction in 2021 and will do so again in 2022, these balloon conversions most likely vaulted her from a 12% tax bracket all the way up to the 35% bracket. Maybe with some creative planning, we could finagle a way to get her down to the 32% bracket, but she's definitely facing higher taxes. So she didn't need to go all the way up there, probably, right? And if for some reason she wanted to really push it and go into those higher brackets, it demanded a conversation and full understanding of what's going on. But for most people, you want to stay within that 24% bracket at the most. For most people, some people need to be more aggressive, and that's okay. A better solution would have been to consider tax brackets before she locked in a Roth conversion. Yes, the markets may be down, as a brother said, but the tax brackets are stable. I like that phrase. Markets may be down, but the tax brackets are stable for now until we're told differently. More precise conversions could be limited to her to the 22 bracket, or if she was willing, inched her into the 24% bracket. For taxpayers who think rates will increase in the future, maybe filling up the 24 bracket now, or even the 32% bracket makes sense. IRMA. We do a study of IRMA costs with every conversion that we do, every plan that we do. IRMA is the income-related monthly adjustment amount that is applied to your Medicare premiums. So these surcharges for Medicare are a cliff, as he says. I'm right here. $1 over an IRMA bracket level, and you dive headfirst into the next pool. It's not progressive. It just is, right? It's like at the Jersey, I don't know what it's like in other beaches. I can't remember, but at Jersey Shore, you often walk in, walk in, and then there's this big drop off. That's how IRMA is. As a single filer with $50,000 of income, this woman was in the bottom IRMA bracket. By adding a $200,000 Roth conversion in 2021 and 2022, she jumped to one of the highest brackets and will significantly increase her monthly costs in 2023 and 2024. IRMA charges are based on modified adjusted gross income for 2 years previous. Take note, it is not just income tax brackets that must be considered before a conversion, but stealth taxes like IRMA surcharges must also be part of the equation. I've run into so many times people don't consider IRMA. It comes 2 years later, they're very surprised. And when they don't have any ramifications in those first couple of years of Roth conversions, and they do it again and do it again, they end up with this wave of higher Medicare surcharges that they're just not expecting. So required minimum distributions. Required minimum distributions had not, I'm right here, RMDs, required minimum distributions had not yet kicked in for this individual. She was only 69, still had a few years to go. Yes, converting her entire traditional IRA before 72 would eliminate the need to take an RMD, but at what cost? For those already taking RMDs, be aware that an RMD cannot be converted. Once satisfied, anything above and beyond the RMD can be converted. Financial aid can also be impacted by Roth conversions. I want to come back to RMDs for a second, as can other income-based programs and benefits. Before doing any Roth conversion, be sure to weigh all factors, not just market conditions. Every person is different, and we all have personal goals and opinions. An oops conversion for one individual could be a home run for another. Tread carefully. Really great piece by Andy. RMDs also, he talks here about RMDs. Remember, for some folks, you don't have to convert every dollar of your IRA. If you don't have pensions, rental income, a significant amount in your taxable bucket that's generating investment income, then you may be able to keep $250,000, $100,000, $500,000, in your IRAs. You don't know that until you go through the planning, but wouldn't it be a shame if you could keep anything, $100,000 or $500,000 in your IRA and not have to convert it and have those RMDs be tax-free? It can happen that way. So you be careful. You got, who you're taking advice from. Your Roth conversions should be reconsidered every single year. If I had our planning associate on the phone here or on this webinar with me, Emily Wheeler, and I asked her how many plans we have where we do the same amount of Roth conversions every single year, she would probably say none, because we have to look at it every single year and take in all the factors and guide you through it. So really, really great stuff from the Slott group. Let me stop my share. Let me see if there's any questions. No questions. All right, folks. Hope you're still with me. Let's talk about investments. In fact, investment markets, the stock markets were pretty terrible last week. The Dow Jones Industrial Average was down over 4%. The S&P 500 was down over 4%. The NASDAQ was down almost 5%, 4.43%. The global indices, other than the emerging markets, were all down. The bond market was down 0.36%. The aggregate bond index, which is, as I said, probably the most typical area that investors invest their bonds, is down again 10% for the year. It corrected a little bit, but we're down 10% for the year. There are bonds that are down 21% for the year. So the safe bond allocation is really hurting a lot of people. I did air quotes if you didn't see, or if you're just listening to this, and safe, because bonds aren't always safe, and they're billed that way. So it's really challenging. The 10-year treasury is at 3.04 at the end of last week. All these numbers at the end of last week, up slightly from the week before. And a year ago, it was at 1.35. So a really tough time in the markets last week. So we had Chairman Powell's comments, and then we also had some information. There's a really great article from First Trust, Brian Westbury, who's the chief economist at First Trust. He really swung hard at the Biden administration and this college debt forgiveness program. So I'm not going to be as aggressive as this individual was, but there's some really great information in here and some things. One of the issues that some of the analysts said are moving the markets now and did last week tremendously is really digging in and figuring out what the cost of this loan forgiveness is, a student loan forgiveness. So it seems to get much worse as the information comes in. So the Biden administration said the changes in the loan forgiveness program will be $240 billion in the next 10 years. The Committee for a Responsible Federal Budget says $440 to $600 billion. A budget model from the Wharton School here in Philadelphia says $1 trillion, but even that $1 trillion might be way too low, he says. The cancellation of some student debt that already exists is only a small part of the policy change. The much bigger change, Brian writes, is the much bigger change, and the one that the market has finally begun to absorb, is limiting future payments on debts to 5% of income, but only after the borrower's income rises above roughly $30,000 a year. So they're limiting future payments, and it's income based. For example, if someone makes $70,000 a year, then no matter how much they borrow, their payments are limited to paying $2,000 per year, 5% of the extra $40,000. That's $40,000 over 30. After 20 years, any remaining debt would simply disappear. So people often use the amount. Well, it's not often. This is why the housing market really took off, because interest rates have been so low. And of course, we have limited supply, and there's part of that too, but people don't buy houses based on, is it $400,000, $200,000, or $600,000? Most people buy it based on the monthly payment. Most people, there are people that just pay cash, but most people use a mortgage and it's based on monthly payment. Well, if $2,500 a month buys a $500,000 house in this interest rate environment, and in a lower interest rate environment, $2,500 a month buys a $600,000 house, well, the value of housing is going to go up, right? I hope that makes sense what I said. In this case, no matter what, you're capped at your payment amount. So what's stopping people from saying, well, typically I would only borrow $80,000 for college, but I'm going to borrow $150,000 for college because my payments are going to be the same. It's going to be based on my income. It's going to be maxed out. And so that really could be problematic. Listen, what really needs to happen, I'm just going to editorialize for a second, is some reform in the college process, right? So, college has gotten very, very expensive. My daughter's 16 years old. She's already, for over a year now, she's been figuring out where she wants to go to college. And we've done the planning, she and I, and she wants to be a physical therapist. That's one of her things. And if she goes the physical therapy route, we figure it's going to cost about $350,000. Well, that's a lot of money in anybody's book, right? So if this program's in place, and I said, well, okay, it doesn't matter, borrow $350,000, you're only going to pay, up to your income limit. It doesn't matter. It doesn't seem right. Right. So the risk of that is the college problem could get even bigger, because they're going to encourage people potentially to borrow more and more money, because they're going to be capped out of really what they have to pay back. And the government's going to let it go at the end of 20 years. But that's really on us, right, as taxpayers. So the government doesn't produce their own revenue in the most part meaningfully. It comes off on us. So that's the gist of that article. And that is concerning, of course. So that helped move the markets last week. There's some good information from MFS this week. So money market funds grew from $3.6 trillion to $4.8 trillion from May 2020 until 8/17/2022. Prior to that, it had dropped. So, but people are putting more money into cash. Is what that's saying. We talked about the U.S. economy contracted, right? Like reduced by 0.9% in the second quarter of 2022. There was a 1.6% contraction in the first quarter of 2022. That's the 8th time in the United States to suffer 2 or more consecutive down quarters since 1960s, meeting one of the often used definitions of a recession. People are still fighting it, but as you heard me, I believe that we're solidly in a recession. We've added as a country $1 trillion worth of debt so far this year, from 12/31/2021 to Tuesday 8/9/2022. The U.S. national debt increased from 29.6 trillion to 30.6 trillion. So that's $1 trillion year to date as of the 9th of August. So it's more than that now. Housing prices have dropped a little bit. So after reaching an all-time U.S. high of $457,000 in April 22, the median sales price of new homes sold in the U.S. has fallen during the last 2 months to $402,000. So it's the first time we've seen that in some time. The average home price in the United States increased 8.1% per year for the 10 years ending May 31st, 2022. But that included an 18.3% increase in prices for the 1 year ending for that 1 year, 18% in that 1 year. In the previous decade, American home prices increased just 1.4% per year for the 10 years ending 5/31/12. So these increases that we've seen in the past several years are not typical. A typical increase in housing that we should see is about 4% a year. One more thing about student debt. So as of June 30th, 2003, credit card debt in the U.S. was almost 3 times the size of student loan debt. That is $690 billion compared to $240 billion. By June 30th, 2010, credit card debt was $740 billion compared to $760 billion for student loan debt. So it started, the seesaw started to go the other way. As of June 30th, 2022, credit card debt, it was $890 billion, but overwhelmed by student loan debt of $1.5 trillion. So if you don't think we have a student loan debt problem, folks, it's time to start recognizing it. And we've got to figure out a way to adjust it or fix it. All right, let's go into our financial planning topic. All right, you should see a whiteboard in front of you that reads financial planning topic, investment fundamentals, asset allocation. So click the raise hand button if you can see that. That'd be helpful to me. Thank you very much. Let me move this bar. Okay, and this is the part where many people join us. We've been splitting our videos. So we've got financial planning topic by itself on YouTube. So I'm just going to remind you, if you're seeing this on YouTube for the first time, just please hit the like, subscribe, and notification button so that you stay on top of our videos. So this is asset allocation. So you folks all hear about asset allocation. So this is the, these are our investment pie charts. So you're going to see me looking down. I'm just going to draw, you see these on presentations and on your statements all the time. Here are your investments, and you got these pie charts, and there's often some risk tool that's used to develop that. But what does that really mean? How are these things derived? Really, what are these pie charts? How does it work? Well, that this is what we call fundamentally asset allocation. Oh, sorry. And this pie chart represents different types of investments. So you might see here large companies. So you'll hear sometimes large growth. So these are large stock companies. The S&P 500, the Dow Jones. Sometimes you see large value. So they're, again, large company. Sometimes these are a blend. Sometimes you'll see large blend. And then you might have mid-sized companies, and you'll hear the term cap. That's capitalization. It just means, how much of the market they have. So mid-sized companies, you might have some smaller companies. You might have some bonds. And international investments, whether they be international bonds or whether they be international stock. You might have some real estate or other specialized holding. Maybe you got a little bit in precious metals, gold, silver, etc. And other commodities might sit here. But that is, that's how we deter, or that is what's called asset allocation. So, very simply, just having representation in each one of these areas. And we're going to talk as we go through this series. So I didn't mention this in the beginning of the start, if you're just joining us on this video, but this is the first of an investment fundamental series. So over the next several weeks, we're going to talk about asset allocation. We're going to talk about active management versus passive management. We're going to talk about risk analysis. We're going to talk about rebalancing. We're going to talk about individual stocks. We're going to talk about individual bonds. We're really going to get into fundamentals of investment management. But today we're going to talk about asset allocation. And we don't want to forget, this is one part of it. How I feel about how do we manage these difficult markets? Well, you use asset allocation. Make sure you've got the appropriate amounts in each section there. You also want an appropriate amount in principal protection to make sure that you have a portion that's going to give you some good returns, some modest returns, but some good dependable returns, but isn't going to go below zero in any given year. That helps you from having to crawl out of a hole. So you got to determine how much to put in each one of these. And then we add account segmentation, and that is simply having a game plan or an asset allocation for each time in your life, so you're properly funded. When I was brought up in the pension world in this business, we called it asset liability matching. We do the same for each individual, but today we're focusing on asset allocation only. So you determine how much you have in each one of these pie charts, and then of course you got to determine the investments that go into there, and you have to make sure that they're the best investments that are available in there. So we're going to talk about how we work through that, right? Like, how do we decide what the best large company growth fund is, or the large company growth exchange traded fund? We'll talk about that. But back to general asset allocation, there are two basic ways to manage your allocations, and one is strategic asset allocation. So what is strategic asset allocation? I pulled these definitions from Investopedia, and anybody can do that. Investopedia.com. I just Googled it, strategic asset allocation. Investopedia is, I really like that one because it tends to have just simple language, and it simply writes, strategic asset allocation is a portfolio strategy whereby the investor sets target allocations for various asset classes and rebalances the portfolio periodically. The target allocations are based on factors such as the investor's risk tolerance, time horizon, investment objectives. The portfolio is rebalanced when the original allocations deviate significantly from the initial settings due to differing returns. So strategic allocation is based on modern portfolio theory. And I actually meant to pull down some information about this, but that was a theory that was derived out of, I think, the University of Chicago, if I'm remembering correctly. And I can't remember the person's name, but he won a Nobel Prize for putting this together. So if one of my regular students are out there who knows details about this, if you want to share the person's name who started modern portfolio theory, I'd really appreciate that. But modern portfolio theory basically says you have your level of risk here, and you have your level of return here. And then we have this thing called a capital market assumption line. So capital market assumption line is, not to get too in the details, but different companies have different thoughts on what we should expect along this line. But we choose whichever one fits, and there's not much deviation there, but it's just what should the growth be, during this, and that changes from time to time. But strategic asset allocation says for a given amount of risk, you get a certain amount of return. So these portfolios sit on this capital market assumption line. And of course, if our returns start here at 0 and your risk start at 0, and let's just say it goes to 10 and the return go to 10, just to keep it simple, well, you can see this is going to be a heavy cash, maybe, a third or a half kind of a principal protected or very conservative. So I don't want to use principal protection because it's a little different. This will be your most conservative portfolio over here, because you're probably at like a 2% return for a 2% risk here. And then as you go further out on here, let's just say you're at a 4 and a 4, and it's not, these aren't the exact numbers. I'm sharing very basic fundamentals for you with you. So you see, as you get more riskier, right, you get a higher return. So more risk here, higher return here, right? You take more risk, go closer up on this scale. And this would be your riskiest portfolio. Now it can go higher than that, of course. You know, you can go all the way up if you're assuming a much higher rate of return. Just depends on your structure. But that's the basics of strategic asset allocation. And most people pick one. Most investment advisors, they'll say, okay, your risk tolerance says we shouldn't be invested this way, so we're going to create this portfolio for you. And then they'll create this portfolio and they'll choose those components that we talked about on the other side. And they'll say that we're going to keep this rebalanced to make sure these components, say if 25% of this should be in the US stock market, and it goes up to 30%, then we're going to rebalance this portfolio and bring that back down to 25% to make sure that things don't get out of whack. And that helps, that structure of rebalancing helps, you know, your volatility. It's been shown to, it helps minimize it, right? So you might get a little less volatility there. I don't know what that's about. And get to the same place just using rebalancing. So again, that's one step in our allocation. But that's how that works. And that's what strategic asset allocation is based on. It's based on modern portfolio theory. And just remember that for the given amount of risk, if your portfolio is constantly rebalanced, you get a certain amount of return. Now, constantly is different for each type of account. With a retirement account, you might default to every 3 months, you rebalance that. With a non-retirement account where you've got some capital gains tax to be concerned about, that might be a yearly rebalance. So that is strategic asset allocation. Now let's talk about tactical asset allocation. Now, tactical asset allocation is often part of strategic asset allocation, but it can sit by itself. Tactical asset allocation is an active management portfolio strategy that shifts the percentage of assets held in various categories to take advantage of market pricing anomalies or strong market sectors. This strategy allows portfolio managers to create extra value by taking advantage of certain situations in the marketplace. It is moderately active. It is a moderately active strategy since managers return to the portfolio's original asset mix once reaching the desired short-term profits. I don't know if I agree with that part of it. I mean, I guess fundamentally that might be the correct definition. I do find that active managers tend to get very active and stay that way. So I tend to lean more on, I can't find my cursor here, more on strategic asset management instead of tactical, or tactical asset management. But it doesn't mean I won't choose a manager for one of these pie charts, these sections of your pie pieces that has a tactical tilt. So usually these tactical allocations won't deviate more than, say, 5% to 10%, but they might say, like BlackRock has a tactical management division, right? So they do strategic asset allocation. They also do tactical. So they might say, and you've heard me say it, you know, we're overweighting bonds right now. So if you're going back to this here, let's just say this holding here of bonds is supposed to be 30%. Well, BlackRock might say, we're going to take this up to 40% in the time being. This is not a recommendation. I'm not saying that's what you should do or that's what they're doing. I'm giving you an example. And then 6 months from now, they might say, okay, we're underweighting bonds to 20%. So they're looking at things in the market and they're making adjustments to see where they should place their money to give incremental advantages. And it's not just bonds. It could be done anywhere. They might say small companies, small US companies, we think are going to outperform. So if there's a 5% rate weighting in here, we're going to take that to 7, or they could take it all the way up to 10. It's really subjective to what the managers and any investment manager can make any changes they want in their portfolio. So that's how tactical asset management works. As a whole, I've found in my career, my opinion only, that the risk, the additional risk that you take by moving things around outside of this strategic asset management model as a whole don't typically pay off. And a really good example is BlackRock overweighted international stocks coming out of the pandemic because they thought that European structure, the EU, the European Union, and the European structure was going to come out of the pandemic much stronger than the US, and they were completely wrong. It was the complete opposite. There is also out there thematic investing. So thematic investing says, okay, this is what these are the areas of the market. It's kind of much deeper than tactical. These are specific areas of the market where we're going to invest our money. A big one was infrastructure, roads and infrastructure. Yes, we need to spend a lot of money on roads and infrastructure, but that's really tied to government programs, and there's a lot of risk there. But there was an investment manager when I started at UBS that was one of the best managers, won the best manager award for 10 years prior to my time starting there. And he was a thematic investor. And I'm really fortunate that I learned this right in the beginning because, we had the dot-com. So I started in 2001. We had a dot-com issue. We had all the issues with accounting, right? Where, Enron and CEOs getting arrested and charged. So it was almost like someone went through his thematic weightings in investments and just checked off each one of them. We're going to hit this, we're going to hit this, we're going to hit this, and just obliterated his portfolios. So in my opinion, you just don't want that. In my opinion, you want, I lean on strategic asset allocation. I will implement a manager like a tactical manager within these portfolios, but not as a whole. I see a question here. Gerard, does the Roth bucket inherently take on more risk since it would be the last place to take funds, hence longer time horizon? Not necessarily. So this is off topic a bit, but let me address it. So what Gerard is saying, if you're focused on your investment buckets and how do you invest those, you have your taxable bucket, tax deferred, and tax-free. And we know we have a mathematically ideal amount that we want in each one of these buckets. We want 6 months to 1 year of expenses. In your tax deferred, so they're your IRAs and retirement plans. You want an amount that, if you can, an amount that generates a required minimum distribution that's below your standard deduction. So that can come out tax-free, but for everybody that's different. So it could be a span of $0 to $500,000, depending on the individual. And then everything else we want to push over to this tax-free, because anything out of tax-free, anything that comes out of here, you pay 0 tax as long as it's set up correctly. And the only things that are truly tax-free are Roth IRAs and properly structured cash value life insurance. So, and I guess you could throw in there health savings accounts, but there are some requirements on how you spend those. So Gerard asks, shouldn't Roth sit here and be most aggressive, right? I think that's what he's asking. Does the Roth IRA bucket inherently take on more risk? It would, since it would be the last place to take the funds, hence longer time horizon. So could be. We have plenty of folks that start drawing their funds out of their Roth IRA in 5 years, right? It could be. It all depends on the situation. You don't always wait until 10 years, 11 years, or that being the last place to draw funds from. You might be in a situation where you're drawing funds from your IRA and you're drawing funds from your Roth IRA because it's about balance. There's nothing wrong with it. So it all depends on the individual, just like everything. Some people never draw from the Roth IRA. Some people just say, okay, I'm going to leave it there in case I need it. I'm going to pass it on to my heirs. I want it to be tax efficient. And that's fine too. So it depends. Gerard. But it's really important to get these allocations right. And then it's really important to put these portfolios that you develop on these on this line here in the right places. Because if you invest here, even let's not go fully aggressive here. I'm here. Let me see. I don't like these pen colors, the way they changed them, but let me try to use it, make things a little clearer. So I like green. Let's do green. All right. So if you invest here, and let's just say that's your typical 60-40 portfolio, and that actually might be more like here. And you've got all your money in there, and I kid you not, people do that all the time. In fact, the majority of people do that. And you're counting on that to fund this year, next year, following year, and all the way to retirement. And you're down 10%. You're taking money out of portfolios that are down 10%. You're never going to see a recovery of that. So you got to be really, really careful, and you could be down 20%. You could be down 30%. You could be down 40%. It happens. And we're going to have some challenging market times. So you got to be really careful where you got to develop these portfolios, put them together properly, keep an eye on them, monitoring. We're going to talk about those as we go through this series. Rebalance, we're going to talk about that. But you got to be really careful where these flow and sit on your timeline. So great question, Gerard. I thought it may not have been applicable, but it certainly was, as it always is. I appreciate that. Well, folks, as always, I hope this was helpful. So we talked about a lot of great headlines today, some stuff to pay attention to. We went over our financial planning topic today, investment fundamentals, asset allocation. It's going to be the beginning of a series over the next 4 or 5 weeks. I hope you join us, not next week, but the following week as we continue with this. And I hope this was helpful. If you have any questions, reach out to me. If you want to schedule time with me, you can send me an email or schedule time. You should see a calendar. Actually, no, you'll get a survey at the end of this webinar. Let me know what you think. Let me know what other topics you might want to cover. I always love hearing your feedback. Have a great day, and we'll see you in a couple of weeks. Take care.